But right now it's time for the big fat idea. Neil McIver, McIver Wealth Management, joins me on the line. Neil, first of all, appreciate you taking time on the weekend for us. And I wanted to start with what you've been doing within your portfolio, your management, the kind of returns that you've been getting and what you've been focusing on.
Well, the portfolios that we run, Mike, and first of all, good to be with you and your listeners this morning, but the portfolios that we run are properly diversified portfolios, and they're mathematically non-correlated. So that means that there's positions inside of them that don't go up and down in unison, and that really reduces the risk quite dramatically. So we're going to have components of cash, bonds, high-yield investments, that would be corporate bonds, preferred shares, U.S. stocks, international stocks, Canadian stocks, and we're going to hedge all of that with gold or food production. And what that does is that greatly reduces the volatility and over time is going to produce superior returns because you're not going to get the downside. But a portfolio like that, if we look at, say, our P3 portfolio, which is sort of right down the middle in terms of risk and return, that's going to get, over the last 6 years, that's returned about 9.16% over that time frame with a very low standard deviation of about 7.4%. So those are the types of portfolios that we run, and again, they're designed to reduce risk dramatically over time.
One of the things you just mentioned there, though, I think is an absolute key, and I want to just come back to it, when you go on a non-correlated portfolio, because I think this is what modern portfolio management has to incorporate. And I'll give you a quick example of where it's not correlated. Where it is correlated, rather, and that's when you think you're diversified because maybe you own banks and maybe you own, I don't know, a utility, etc. But when the interest rates move, they're all going to go down together. Or when we've had these major stock market declines, everything goes down. That's not correlated. I mean, that is correlated, and that's not what you want.
Well, that's right. I mean, many people believe that a properly diversified portfolio is owning both oil and natural gas, and that's not what we're talking about. So non-correlated positions. So if you're going to own a lot of fixed income investments or a lot of banks, you're going to want to own gold or something that's going to go in the opposite direction when the interest rate turn finally happens and interest rates go back up. So non-correlation is something that we can actually identify now using computers effectively and using the power of them to look for negative correlations in the markets, maybe even some that you hadn't realized before. But that's the single biggest issue, I think, in my business that I run into when I take a look at portfolios that have underperformed for the past number of years or even decades, is that positive correlation, people owning, all fixed income or all interest-sensitive securities inside of a portfolio.
Yeah, and they all move in the same direction, whatever the move is. I couldn't agree more with you. Now, one of the things we chatted about a little bit, so I get a little precursor, is you're thinking, just going to talk to Ozzy about it, that maybe it's time to take a little money off the table if you're talking about Vancouver, et cetera, in the real estate market, and maybe look at something, a non-correlated portfolio.
Well, absolutely. And my big fat idea this week, and you had one a couple of weeks ago, I think, with when Victor hosted the show, and that was about selling real estate in one part of the country and buying another. But I'm going to take the radical position that I think it's a good time to consider taking some profits off the table in real estate and investing that into the capital markets. Now, that probably won't make me a lot of friends in the real estate business, but that's really not what we're here to do. So to be clear, though, this is not your primary residence that I'm suggesting. This is investment properties, homes, apartments, townhouses, that type of thing, and consider moving those types of investments into a portfolio in the capital markets that's fully liquid.
Okay, and moving that, as you say, into the capital markets, obviously you need to link up with somebody who's got some portfolio management experience and a good track record, I should have said first.
Well, that's the key, is trying to find that. That's not an easy thing to do, but finding a talented portfolio manager that's got a steady hand and a track record that goes back. But just to give you an example, if you take a look over the last 6 years in the Vancouver real estate market, and we're focusing here on Vancouver just because there's been such a meteoric rise, but Vancouver detached homes have grown at an average rate of 11.5% over the last 6 years, from January 2010 to January 2016. But if you look at townhouses, the rate of return has been about 4.53, and condos just about 3.51. But if you look over that exact same time frame, that same portfolio that I was talking about earlier has had a rate of return of about 8.26%. And if you built a portfolio maybe that's a little bit more growth oriented, our P5 portfolio, Not to toot our own horn, but that portfolio was averaged about a 10.23% rate of return over that exact same time frame. Now, obviously, past performance doesn't guarantee future performance. That's true for real estate or our models. And to be fair, the real estate numbers that I gave you don't include rental income. But real estate also, the real estate numbers also don't include transaction costs, maintenance costs, taxes, rental costs, special levies, strata councils, headaches, all the things that we know take place with owning investment real estate. So I think the time is right, and I think it's going to provide the average investor with greater liquidity and certainly more diversification, because one of the things I think that people forget is when real estate when an asset like real estate rises the way it has in much of the country, people become too concentrated in that one asset class, just as we were talking about correlation before. They become too concentrated in one asset, and that effectively increases your risk over a period of time, and you don't want that to happen. So it makes imminent sense, I think, right now to take a little bit off the table.
And again, this would be appropriate whether you're an aggressive growth kind of person, a conservative kind of person, doing some sort of mix kind of person.
Absolutely, really for anybody, provided that real estate is not, of course, your primary home. It's important to leave that out of the equation. But absolutely, and you can even leverage the strategy that I was talking about. One of the reasons why people have such a good experience with real estate is it's primarily leveraged for everybody. So even if you do get a 3 or 4% rate of return, if you're only putting 25% down, that's giving you a rate of return in the range of 8 to 10% over a period of time because of the leveraged effect.
And as you say, whatever asset you happen to own, we're talking real estate because it's risen so much, it then starts to dominate your own financial picture. And you got to maybe readjust a portfolio like you would if the oil stocks went crazy or the gold stocks went crazy. You readjust and get back into that balance, as you say. Neil, thank you so much for taking the time. Great stuff. You can find more with Neil at McIverWealth.com, MCIVER Wealth.com. Neil McIver, McIver Wealth Capital. Thanks, Neil.